Thank you, Joanna. Thank you, everyone. Good morning. And also thank you for spending your Saturday morning joining our webinar today. So yeah, my name is Randee and I'm one of the bond dealers in FSMOne. Okay, before I start, let me try to share my screen. Okay, just want to make sure you guys can see my screen, right? Joanna, can you see the screen in full?
Yes, I can see the screen.
Okay, great. Okay, so as you can see the topic here, the reason why we are doing this topic is that throughout the years, we often heard feedbacks from the investor saying that sometimes they find it difficult to go through all the bond official documents like the information memorandum and also the official offering circular, etc. Because normally these kind of official documents, right, consist of more than 100 pages, sometimes can go up to 300 and 500 pages. So they don't really get to what is the important news that should actually see. Okay, and also all those bonds that has special features might have some terms and wordings that might be too technical and also too complex. That's why we're having these sections to address all these issues and also present it in a more structured way and also in a more layman way. Okay. So before I start, just some disclaimer here. Whatever the bond name shown in the section later on is not any offer or invitation to buy. Okay. So in these 50-minute to 1 hour sections, I will be going through basically 3 sections. The first one is to guide you guys to differentiate different types of bond documents. Okay, and also secondly, we'll be specifying into the bonds terms and conditions that you can see in most of the bonds. Okay, and finally, before I end the section, I will also try to highlight the common bond features that you would see in those perpetual bonds and also the bank subordinated bonds, which is what we normally call it as the hybrid securities. Okay. So without further ado, let's start off with our first section, that is to differentiate the types of the offering documents. Okay, so I will begin with maybe introduce you all on how do those companies normally make bond issuance. So when you are thinking about on the equity side, right, when a company, they want to get his company to be listing or they want to make another equity offering, right, they will actually have to apply it through our Securities Commission, which is our regulator of the capital market. Okay, so with what they normally do is that they will normally go through many process and also submit tons of the documentations. But the documents, right, that is circulating among the investors, right, is what we so-called the prospectus. Okay, so prospectus is just the documents that entails all the deal structure and also the most relevant information regarding the company. Okay, so same goes to bonds. When the issuer, they want to make bond issuance, right, they will also have to apply through the Securities Commissions, and they will also have to submit documents to the SC. But in the end, right, the documents to be circulating to the investors is also the prospectus, but they don't call it prospectus. They normally call it as the information memorandum, or sometimes they call it offering circular, depending on the country jurisdiction. But eventually they are under the same type of prospectus. Okay, and also in Malaysia context, right, what I'm trying to share is that there is no strict rules regarding the format of the content or even the specific information that must show in the bond prospectus, but they will have to follow the country rule in order to give a standard content there. But in terms of the wording or the sequence, right, there's no fixed rules to follow actually. Okay, so these will be the documents to be circulated before the bond really issue. Okay, and secondly, if they successfully close the bond deal that finalize every details of it, right, they will come up with another document that is called trust deed. Okay, so trust deed is actually a legal document between the issuer and also the bondholders, where issuer is legally bound to carry out all the duties and also its obligation throughout the bond life, the bond period. Okay. And also they are responsible to carry out the financial duty to its bondholders, and also to make sure all the terms and conditions stated in the trust deed are enforced and also carried out. Okay, but for that, right, in order to make sure they really do it, we will need someone to monitor for us, right? So in that case, right, a trust deed is appointed to help us monitor. Okay, so trustees are normally the financial institutions that have the trust powers to help us monitor whatever the issuer has done or not yet done. Okay, and also they are actually the representative of bondholders to collect the coupon payments from the issuer and then subsequently distribute to all the bondholders in that case. Okay, and this will be, so you can see the difference here. Bond prospectus are normally before the issuers to be circulating in the among the investor market. Okay, and trust deed is the final legal documents that specify every bond details and also the terms and conditions. Okay, and last documents will be the principal terms and conditions, or we call it PTC in short. Sometimes people also call it as pricing supplement. Okay, so as you can see the name here, supplement, it literally means it's not a mandatory document to be furnished. Okay, because what I would say is that these PTC documents, right, is purposely extracted from the bond prospectus, because in this PTC, right, it also specifically highlights all the deal structures and also spelled out the terms and covenants that issuer must follow. Okay, so the reason why they purposely come up with individual documents is just, I would say, it's just for investors to reference it easily. Okay, so for bond issuance, right, these will be the three common types of documents that you can see whenever you see a bond that is being issued. Okay, so like I said just now, there is no fixed format or content to show in the bond prospectus, right? But this, I would say, is the most common types of content that you can see in most of the bond documents here. Okay, so I understand these bond documents can be extremely long, where you find it difficult to really pour over all of it. So if you are the first starter, I will suggest you to at least go through the first section, which is the executive summary. Now these sections, right, actually provides or summarize the overview of the information that you can see in the bond prospectus, and it usually consists just 5 to 6 pages, so you can easily finish it within 5 to 10 minutes. Okay, but if you want to know more about the bond deals, right, the bond structure, right, I will also strongly suggest you to go through the PTC sections. Like I say, these PTC sections specifically highlight the deal structures and also the T&C, the terms and covenants for the issuer to follow, to comply. Okay, and if you wish to know more about the background of the company, they also have it in a particular sections where you can go through it as well. Okay, and also you might understand as well, some bonds, they will have a third-party guarantor, or they even have a asset to be pledged as the collateral in this bond issuance. So they also provide full details inside in a separate sections for you to read through and understand it. Okay, and the moving section is called investment consideration. It's just the material information that you can see related to the company and also the company's course of business. Okay, so the example would be the potential business risk and also the ownership profile, and also it can be the suitability profile for you to make further reference. Okay, and also some issuance, they also include the industry overview, the industry outlook, and also what they think about their company's prospect in future term. Okay, and some other appendix or some other material information can be the financial statements at the time of issuance for investors to make more considerations, to think deeply. Okay, so I will say this is the most common content that you can see in the bond prospectus. But up to that point, you will still find very difficult to really specifically on what to look out information, right? So this will be the elements that, in my opinion, I think is appropriate for those first-time reader to really go through the bond prospectus. Okay, I'll call it as sort of like the starter pack here. Okay, so after slowly you go through all the things here, right, you can catch up the habit to read the documents. Then you'll be able to find what is the elements that sounds important to you. Okay, so the first one, I would suggest you to look at the purpose of the bond financing, which can be found in the executive summary. Okay, and this normally sums up in a sentence of two only. Okay, they just specify what are they going to use this money for. Okay, why do I say this is important is that when, let's say, if a company, they want to use this bond financing for specific project development, right? But it turned out that they are using these funds for some other purpose. So in that case, right, it will be considered as violation of the purpose already. So we will need to make sure issuer they carried out, they also use this fund properly. Okay. And secondly, if there is any bond that has securities or collateral, right, all the informations will be contained in the PTC sections as well. Okay, so for information, maybe this bond has a piece of land being pledged in the collateral, right? Then at least you have to know the details of the land specifically. Let's say where does this land locate, and also what kind of land is that? Is it a project development, a property development land, or is just for some agricultural land? So you have to know the purpose of the land, and also how do they evaluate the market value, these kind of things. Okay, so all the full details you can search it in the PTC section as well. Okay, and thirdly, I would say is the bond covenants, where this is the T&C, where issuer they have to follow throughout the bond period. Okay, you can find it in PTC as well. And also under what circumstances that it should consider to be default. Okay, and lastly, you will also need some time to take a look at the potential investment risk that could happen. Okay, under what factor they will affect their business operation, etc. Okay, so as you can see, this is, in my opinion, I think is the most important elements for investor to look at, and you can see most of the information can be found in the PTC sections. That's the reason that the issuer is specifically split into a individual documents for this PTC section, because eventually it just sums up the deal structure of it. Okay, and from here, right, I would say these two are the most tricky one, I would say, because all the terms stated in there, right, is a little bit more legal term, and also the tone, the wording can be quite technical and also quite complex. So from now on, I will try to break it down in a more structured way, and also in a more layman way for better understanding. Okay. So I'll start off with the bond covenants. By definition, right, bond covenants is just the legal binding terms of the agreement between bond issuer and bond holders. Okay, so it's just the T&C that the issuer must follow. So from there, right, they also split out into two different covenants. One is called positive covenants. So as you can see, the name suggests, right, positive covenants, it just means the things that issuer can do and they must do. Okay, as simple as that. So it's just the requirement for the issuer to perform certain action and also to comply with the P&C. Okay, so the common example I would say is that the issuer must pay all the coupon payments and principal on time. This is the things that the issuer must do, right? Okay, and also they have to make sure they are using the bond proceed properly based on the purpose stated in the bond documents as well. So if let's say you are buying one ESG bond, let's say, but then you find out that the bond proceeds, right, is not used for ESG related activities. So in that case, that will be considered as a violation or breach of the contract already. Okay, so everything stated that clear that issuer must follow. So secondly, I guess you can also tell this negative covenants, it just means that the things that issuer cannot do and also must not do throughout the period, okay, to avoid them from engaging certain action. Okay, so the common example that you can see in these negative covenants can be the restrictions on their refinancing activities. In another way saying, meaning we have to add one clause to restrict the issuer, the company, for borrowing more and more. We have to set a limit in order for the issuer not to borrow more than they can afford. Okay, so maybe we can set a debt limit of maybe 70% out of his total capital. So if they exceed this amount, right, then it will be considered as the breach and violation as well. Okay, and also for those bonds who have asset being pledged as the collateral, right, we will need to also add a clause to restrict them to sell the asset before the bond matures. Okay, because if not, right, then they can just do whatever they want to do with the collateral, so it doesn't make sense to the bondholders. Because you have to remember, bond covenants is the clauses to protect the interest of bondholders and the issuer as well. Okay, and they do also have another two covenants. One is called financial covenants. Okay, so if you are the person who are good at analyzing the accounting figures, right, so this might be more familiar to you. Okay, financial covenants just means the requirement for issuer to maintain certain financial ratios in order to make sure the issuer are able to pay back the money. Okay, so some financial ratio can be the gearing ratio, which is the debt level that the company can have. So like I say, maybe they want to control the debt to capital ratio up to a certain percentage. Okay, so if they exceed that percentage, right, that will be considered as the violation already. Okay, and security ratio can be one of the ratio to be shown there, which is the value of the security over this bond issuance size. So in this case, right, the higher the security ratio, the better it will be, because the safer it will be. Okay. And third one, the minimum net worth test is just mean how much extra the asset has over the liability. Okay. So in this case, the higher that is also going to be better, because you have more access than what you own to the bondholders or creditor. Okay. So in this case, I would say financial covenants, they are actually the indicator and also the warning sign for the bondholders in order to monitor the issuer's credit profile, their credit quality, okay, throughout the period. Okay, and also the last covenants I would say is the information covenants, and these covenants normally applies to the listed companies where they have to make sure they can furnish all the documents to the authorities like trustee and regulator on time. So the documents can be, let's say, the financial statements. Okay, so they will have to make sure they can submit all those documents on time, or any other documents that is requested by, let's say, Bank Negara Malaysia or even Securities Commissions. So from here, right, you can see what I want to say is that bond covenants can be extremely important to bondholders, because this belongs to the rights of bondholders, and also what we can do to monitor their whether this issuer really comply with all the T&C stated there. Okay, to also ensure they can pay back the money, meaning the coupon payment and also the principal. Okay, so like I say, all these covenants are basically the terms that issuer has to follow, and if they fail to do so, right, it will be considered as breach, like I mentioned, all this while, and such violation, right, will actually constitute as a technical default. Okay, and take note of what I say here. I say this violation, right, will be considered as a technical default, not an actual default here. Okay, so I guess it's time to take a look at different types of default case in bonds. Okay. So here are the different types of defaults. So for those issuer that fails to pay any coupon payment or principal, right, that will definitely trigger the actual bond default here. Okay, but one thing to take note is that whether this bond, maybe I put it this way, maybe this whether this bond has any hidden or any additional clauses attached to this actual bond default case. So some bonds, they will have a grace period granted to the issuer, meaning grace period is just the number of days after the payment date granted to the issuer to give them have more times to prepare the funds without triggering any default or penalty. Okay, so meaning to say, let's say I'm supposing it to pay you the coupon payment today, but with the grace period of 10 days, right, I can actually drag your payment up to 10 days after. Only after the 10 days we will consider as the actual default case here. Okay, so this is what we call it the bond actual default. So you also have to take note whether the bond that you're holding has any grace period to be granted. Okay, and all these is actually stated in the bond prospectus as well. Okay, and for the second type of default is called technical default. So in this case, like I said, technical default is not the actual bond default. It's just the violations of the legal provision, like the terms and also the components stated inside the bond prospectus. Any violation, right, will be a technical default. But since this is not a actual default, right, so what issuer can do is that they can request for a waiver from the bondholder. So what they will do is that they will normally hold an EGM meeting to seek for the consent for all the bondholders to waive such violations. Okay, so they will have to gather at least majority of the votes, meaning at least 50% in terms of the bond issue size. Okay, so and also in order to encourage those bondholders to vote for them, right, they will normally offer them sort of the consent fee to incentivize them to do so. Okay, so if the consent is granted, then the violation will be considered waived and the bond will just keep rolling as usual. If they don't get the majority support, right, then they will eventually trigger the actual default case. Okay, and one thing to highlight is that under technical default, right, the violation of clauses can be any clauses other than missing coupon payments and principal. Okay, so meaning to say if they fail to pay, issuer fail to pay coupon, right, this is considered actual default already. They cannot ask for waiver or they can ask for negotiation. No such thing. Okay, so final type of default will be the cross default here. So cross default is in a simple way, it just means that when issuer has two bonds, right, bond A and bond B. So when bond B they fail to pay coupon payment, right, bond B will be default already. But that if the cross default exists, right, then bond A will be automatically be defaulted as well. So this is what we so called the cross default. Okay, so hope you guys really understand the difference between these default case. Okay. So from here, just guess we have to look at a real example on how they really construct the clause and also how they construct the wordings here. So this is the offering documents, the bond prospectus that I got it from China Evergrande Group, and they also specifically highlight the particular bonds that is obligated in these offering documents. Okay. So this is how they construct the clauses under the event of default. Okay, so the event of default is as follows. If there's any default in the payment of principal at maturity date, okay, and there's also any default in the payment of interest, meaning the missing coupon payments, but with the condition of granting these 30 calendar days of grace period. Okay, so they won't specifically name the grace period of how many days. They'll just construct it in a sentence way for you to really read carefully and also understand it. Okay, so any other than missing coupon or payment, any other breach of the provision of covenants under certain event like this, consolidation, merger, and sale of assets, or any defaults of the performance or breaches of other covenants, right, will be considered as the default already. Okay, but remember I said anything other than missing payments, right, falls under the category of technical default. It's not an actual default. So we have to make sure whether they have any other additional clauses to sort of give the precaution here. So you can see here they also add another sentence saying that the bondholders of at least maturity in terms of the principal amount, meaning the bond issue size, in order to get, when they get the maturity consent, right, they can actually waive all the past default, okay? But excluding any other than the non-payment of principal and also the interest of the bond. So they stated that clearly, meaning anything other than missing payments, they can actually ask for waiver to waive all the violation in order to keep the bond going on, okay? So up to this point, that's the end of part one, understanding the types of documents and also what is the specific T&C you can look at. Hope you guys really understand maybe the concept of it in order to get yourself started with it. Okay, now let's deep dive to a more specific bonds that you can see in the hybrid securities, the specific features that you can see inside. Okay, so by definition, right, hybrid securities is the bond that combines the characteristics of debt and also the equity. So the characteristics of debt, meaning to say this is the bond they still paying you regular coupon payment, but the bond tenor, right, can be exceptionally long, or even they can issue in a perpetual structure. This is what we so-called the hybrid securities. And this will be the common types of hybrid securities. So as you can see here, the first one is called the perpetual bonds. So perpetual bond, it just means it has no fixed maturity date, but there's an option for the issuer to redeem back the bond on the call date. Okay, it's the option that belongs to the issuer. Okay, and secondly is called the convertible bond. Okay, meaning convertible bond, meaning to say, right, this is the bond that can be converted into shares. Okay, can be converted into shares. But definitely when you want to convert to share, you have to see whether there's any specific event to happen in order to trigger this clause. Okay, and thirdly will be the bank subordinated bond. So bank subordinated bond is just the junior ranking bond that is ranked below the senior bond. So you can actually take it similar to this bond seniority here. Okay, and also as you can see, right, the what we so-called the hybrid securities can be quite complex, and also it consists of quite many much uncertainty compared to the normal bonds. That's why they, under these securities, right, they will normally give a higher coupon or higher yield at the time of issuance. Okay. Just a second. Okay. So when we want to make any investment decision into these hybrid securities, right, we have to understand the story behind on why there is a demand for such securities, even though they are too complex, they are too hard to understand, right? We have to understand the logic behind. So from the issuer standpoint, right, it definitely brings some benefits to the issuer. So first thing first is going to be the recognitions of these perpetual bonds. So for perpetual bonds, right, under market convention, they still categorize it under debt, where the coupon payment is actually tax deductible. Okay, but for balance sheet recognition, right, when they submit the financial statement to BUSA or to any regulator, right, the perpetual bond, the issue size is actually parked under equity sections instead of liability sections. Okay, so what does it bring benefit to the issuer? So they can actually manage their balance sheet profile and also the financial ratio actively. Meaning to say, if let's say this issuer, they have a financial convenience to maintain the debt to equity ratio to not more than, let's say, 100%. Okay, but they want to borrow more debt, so they can issue a perpetual bond. So in that case, right, they are not increasing the debt portion, so their debt to equity ratio is not getting worse in that case. So this is so-called they can actively manage the balance sheet and also the financial ratio. Okay, so from there, right, due to this specialty and also this exclusiveness, right, this bond might be suitable for other clientele, which adds more funding sources to them. Okay, and with that, right, it can be costly in terms of their borrowing cost, but it gives them the flexibility. Okay, meaning to say, because like I said just now, perpetual bonds is they have no maturity date. They say a date for issuer to choose whether they want to redeem back the bond or not. So it gives them the flexibility. Okay. So from investor standpoint, it can be quite straightforward. For this kind of hybrid securities, right, it gives them a higher return compared to those normal senior bonds. Okay, normal bonds, I would say. Okay, and also since they are still called it under bond, the investor are still receiving the regular cash flow from the coupon payment. Okay, and also the bond price are less sensitive or less volatile in that case. Okay, and since they are also under bonds, right, so in the event of liquidation, they actually have better recovery rate than the common shareholder. So this, I would say, the benefits that brings the appealing effect to the investors, because some investors, they are just seeking some high yield investment opportunity, right? So they can actually consider in these hybrid securities, but they have to understand the special features that contain inside these securities. Okay, so I guess it's time to look at the common features that you can find in all these perpetual bonds, convertible bonds, and also these bank sub-bonds. Okay, so first thing first is going to be the issuer cost selections. So like I said just now, it's an option for issuer to redeem the bonds on the call date or any specific date before the maturity. It's the option for the issuer to do so. Okay, and the redemption price can be either at 100 or any other price stated in the bond prospectus as well. Okay, so this is I would say it's quite a common feature. Okay, and the second features is what we so-called the deferred interest payment options. So it is also an option for issuer to choose whether they want to delay or defer the coupon payment to the bondholders without triggering any default, be it technical default or bond actual default. Okay, there's no any violation of such default case for this kind of hybrid securities. Okay, and normally the deferral options, right, can be either cumulative or non-cumulative basis. Cumulative basis meaning that if I skip this round coupon payments, right, then next round when I want to pay you back the money, I have to pay for whatever I owe to you. Okay, but for non-cumulative, right, meaning to say if I skip this round of payment, then next round I will only pay the money that is due for this round. Whatever I owe to you last round, I will not supposed to give you back. This is what we so-called the non-cumulative. Okay, so you have to be clear on the different types of it. And also the third features will be called the step-up margin. Step-up margin is just the increment of the coupon rate when there's any specific event trigger there. Okay, so in this case, right, the trigger event can be for the bond that is not being redeemed or being called by the issuer, or there's any breaches or violation of the covenants. So it will trigger this step-up margin to increase the coupon rate to a certain percentage. So this is sort of like the penalty given to the issuer, because they are not doing what they're supposed to do, right? Although they are not legally bound, but they are still have to sort of like to be penalized. So this is one way of penalize them. Okay. And the next two features, right? This dividend and capital stopper and also dividend and capital pusher. So these two normally exist together, and they are so closely tied to the deferred interest payment options. Okay, so let's talk about the stopper clause here. So if let's say the issuer choose to defer your payment already, so when they defer you the payment, they are not allowed to pay dividends to the shareholders or pay coupons to any junior bondholders, because you as a bondholder which rank higher than the shareholders and some other junior bondholders, right? They are supposed to honor you first before they can make any payments to those that are ranked below you or beneath you. Okay, So this stopper clause will add this to protect the interests of existing bondholders. And if the issuer they want to declare dividends or pay coupons to the holders that is below you, right? They will have to settle whatever they owe to you first. This is what we so-called the dividend and capital pusher. Okay, they have to settle whatever they owe to you, then they can only to consider some other holders that is below you. Okay, so all this actually brings additional protection to the bondholders, even though they have the options to defer your coupon payment. Okay. And the last features I would say is the make-whole call, which is pretty simple. It's also an option for the issuer to redeem the bonds before the bond matures or before the call date. Okay, so as you can see here, quite many of these bond special features, right, provides the options to the issuer to do so. So it gives them the flexibility to easily control their cash flow management and also their business operation, etc. Okay. So up to this point, you might have questions on what if the perpetual bond that I'm holding and the issuer decides not to redeem back the bond on the call date, what will happen? Okay. So technically, if the issuer chooses not to redeem back the bond, right, the bond will still be there. Okay, they will still exist there until the next call date for the issuer to make their decision again. Okay, but before that, right, the coupon rate will be revised by either two ways. So the first way is to recalculate the coupon rate based on the prevailing country yield and also plus the fixed credit spread. Okay, so this is one of the example, a bond that is issued by Affin Bank. Okay, so this Affin Bank gives you 5.8% of coupon rate, and this is a perpetual bond, while its next call date is in 31st of July 2023. Okay, so on this date, right, if the issuer they don't want to call back the bond, they don't want to redeem back the bond, they have to reset coupon rate based on 5-year MGS yield, because this bond is 5 years non-callable features. So we have to take 5 years benchmark plus a specific credit spread, which is 2.015%. And this credit spread, right, you can actually find it in the bond prospectus, which is stated there black and white clearly. Okay, this is one way to evaluate it, to recalculate it. And the second way is to increase the coupon rate just simply by increasing it. So this is the bond that just issued last month, issued by Tropicana Corporation. Okay, and the coupon rate is 6.6% per annum. And the perpetual bond, this perpetual bond has the next call date of 5 years after. Okay, so let's say after 5 years, the Tropicana, they choose not to redeem back the bond, right? Then they have to increase the coupon rate by 2%. So your new coupon rate will be 8.6% already in year 6. Okay, and moving on, every year they will also give them the option to redeem back the bond. If they choose not to, right, then there will be every 1% increment up to the maximum of 15% per annum. Okay, so it's also these clauses, right, I would say is also a clause to encourage issuer to redeem back the bond, because it doesn't make sense for them to pay such a high interest cost. Okay, so I've covered for whatever features that you can see in the common hybrid securities, but there's one I would say unique features that you can see in the bank subordinated bonds. Okay, so before I start, right, let's try to understand the capital structure of banks in terms of their creditor hierarchy, meaning to say when the issuer face any liquidity crisis or they have any financial difficulties, right, there is also a ranking of their repayment, the priority of payment in the event of liquidation. So you can actually take it similar to the bond seniority. Okay, so all these capital structure here, right, are the liabilities of the banks. Okay, so they categorize it into senior capital and hybrid capital. Okay, so senior capital are just those liability like senior secured bond, the term deposits, and also some senior unsecured debt. Okay, and hybrid, you can see they categorize it as tier 2 subordinated debt, we call it T2, and also additional tier 1 capital, we call it AT1, and the CET1 capital, the common equity tier 1. Okay, so in the event of any liquidations or any losses, right, the CET1 capital will absorb the losses first, and then whatever that's left, right, will be absorbed by the AT1 capital, and then whatever that's left will be still absorbed by the T2 subordinated debt. Okay, so let me just briefly introduce what is usually contained in these different hybrids. So this CET1 capital usually are those common shares and also the bank's retail earnings. So if let's say banks are suffering losses, right, or they are having any financial difficulties, right, they will have to use their common shares and also the retained earning to absorb the losses first. So if the losses is still more than they can absorb, right, so the extra will be absorbed by the AT1 capital. So in this category, right, normally are those convertible bonds and also the perpetual bonds. Okay, and if they still have some extra losses, right, it will be taken up by the T2 subordinated debt. So under this debt, right, they are also the convertible bonds and also the perpetual bond. But they, in terms of the ranking, right, they are ranked higher than the AT1 bond, AT1 capital. Okay, so in terms of the risk and reward ratio, definitely the lower the ranking it is, the higher the return and the risk as well. So in terms of the insolvency event, definitely senior holder, they will get paid first. So whatever that's left will only pay to tier 2 holder, AT1 holder, and then finally come to this CET1 holder. Okay, so understand the creditor hierarchy already. Let us look at the unique features that can be found in the bank subordinated bonds. Okay, so they call it as the non-viability loss absorptions. Okay, so these absorptions, right, is actually a mechanism that triggers when a bank becomes insolvent or they are facing any financial difficulties. Okay, so let us look at the definitions, which you can find it in the bond prospectus as well. So they normally define it as the issuer, they shall, without the need for the consent of the trustee or bondholders, to write down, meaning to cancel the principal amount or to cancel the accrued interest upon a trigger event. Okay, meaning to say if there's any event stated in the prospectus that triggers, right, then they will have to cancel the bank subordinated bonds. And also in the case they might not pay you the accrued interest if specific event happens, and these events, right, normally will hurt the bank capital structure. Okay, and all these trigger events are usually linked to the capital adequacy ratio and also the judgment made by the regulator. So in this case, there will be the Bank Negara Malaysia if they have any concern over the bank's financial viability. Okay, so if they choose to declare or to trigger these loss absorptions, right, there are two actions that can be done. One is to cancel the bond, to write down the bond, whether in full or partially. Okay, or for those convertible bonds, they can actually convert the bonds into equity because they are reducing the debt level. They are adding more equity portion into the CET1 ratio, CET1 capital. Sorry. Okay, so this will be the common two events that on what the banks can do. Okay. So how do they actually evaluate this non-viability event? Okay, there are two ways. So the first one is what we so-called the mechanical trigger event. Okay, so this event only happens when the capital adequacy ratio of the bank, meaning the CET1 ratio, falls below a certain figure. So in Malaysia context, right, the trigger level will be at 5.125%. Meaning to say, if let's say a bank's CET ratio falls below this level, right, then they will trigger this loss absorption event to let those hybrid securities to absorb the losses in order to increase this CET1 ratio. Okay, and for Singapore context, the CET1 trigger percentage is anything below 7%. Okay, so under this mechanical trigger, right, there's some guideline for you to follow, but it can be another type of trigger event, which is solely depend on the judgment on the regulator. It just means if bank negara, they just don't feel secure in your bank's capital structure, right, they can actually instruct the bank to let the hybrid securities to absorb the losses in order to increase back the CET1 ratio. Because CET1 ratio, it just reflects the liquidity positions of the banks. Okay. And up to this point, I know these clauses, it might sound scary a little bit, because as a bank hybrid holders, right, we might not get anything if the event triggers. But what I can share is that throughout the period since the implementation of these clauses, right, we don't see there's any Malaysia bank that triggers this loss absorption, okay, throughout the years. Okay, so that is, in my opinion, I think we can actually consider to put a portion of our funds into these hybrid bonds. Okay, here are the reasons. So first thing first is that all the Malaysia banks are actually well investment graded for all the capital types, meaning the senior capital, the tier 2 capital, and also the AT1 capital. They are all investment grade, which shows that they have the strong credit quality and also strong profile to make sure all the coupon payments can be made on time. Okay. So as you can see the table here, which shows different banks in terms of their ranking by splitting into different capital structures, senior, tier 2, and also AT1. And you can see here, among all the top 5 banks, right, they are actually ranked at least AA and above. Okay, and for those medium-sized banks, right, they are at least ranked as single A and above as well, which shows them the strong credit profile to honor all the debt obligation. Okay. And the second point I would say is the strong supervision power made by the regulatory authorities. Okay, Bank Negara Malaysia, they do closely monitor the liquidity positions of every banks every day. Okay, one thing you might not know, for banks, right, until the end of the day, right, they will have to do a reporting of their liquidity positions every day to the Bank Negara. So in that case, right, all of their positions are closely monitored on daily basis. So if, let's say, Bank Negara, they find something wrong, right, they can actually voice out earlier and to amend the situation from getting worse. Okay, and we also know all the while, right, the Malaysia banks have been heavily regulated for so many years in Malaysia, and they also have to make sure the consistency and also transparency is there to make the regulatory path to show some improvement here. And what I can share is that although you might be concerning on the CET1 ratio, right? Because the trigger level is any percentage below 5.125%. Okay, so I can share with you throughout the years, right? All the Malaysia bank, the CET1 ratio is ranging at least double digit. Okay, so for the past 5 years, right, the CET1 ratio is ranging around 14% to some can be go higher to 20%. So it actually gives around 3 times buffer to cushion the event from happening. So this is why I would say it can be a good investment opportunity to invest in some of the bank hybrids bonds. Okay, and the third element that I think is good to invest in those banks hybrid bonds, right, is the you pick up from the same issuer. Okay, meaning to say, if you have confidence in a particular bank where they will not declare such loss absorptions, right, actually you can pick those slightly low ranking bonds in order to get a higher yield. Okay, so this is the debt or bonds issued by CIMB Bank based on its capital structure. So if you have confidence or if you have faith in these banks, right, you can actually consider their hybrid bonds, either tier 2 or AT1 bonds. So it still gives some quite a good yield from there. It can give to ranging around 2.85% for tier 2 bond, or even 2.93% for AT1 bond. Okay, So this is just my opinion why you can actually think of investing some of your money inside these bank hybrid bonds. Okay. So and again, before you make any decisions also, right, here are some indicators or some guidelines for you to follow if you want to analyze the hybrid securities. So for corporation bonds, right, like perpetual bonds, right, first thing first, we're gonna analyze the credit fundamental of the company to see whether the debt level of the company is at a reasonable level. Okay, so we can always look at the balance sheets to check on their gearing ratio and also their debt maturity profile. Okay, and the most important thing I would say is whether this company has a strong cash generating assets to be consistently paying all the coupon payments or the debt obligation. This I would say is the most important element. Okay, and we can also deep dive into the hybrid structure of the bond, meaning to say whether this bond has the deferral interest payment option and whether this option is in cumulative basis or non-cumulative basis. You have to really be clear on the bond that you are considering. Okay, and also sometimes the seniority and also the collateral can be another consideration to you as well. Okay, and for bank sub bonds, right, the analysis is similar to the corporate perpetual bonds. But if let's say you want to have some idea of whether this bond is ranked under AT1 bonds or tier 2 bonds, right, here are some tips for you. So like I say, AT1 is ranked below tier 2 bonds, right? So they are normally issued in a perpetual structure. Okay, and the seniority of this bond is normally at the junior subordinated rank. Okay, and for tier 2 bonds, which is one rank higher than the AT1 bond, they have the fixed maturity date, but they will have the early call features to redeem back the bond, and they are also ranked at the subordinated ranking, which is higher than the AT1. Okay. So here are just some checklists for you to read through. Just want to make sure that you can answer all these questions to you before you can make investment decision into those hybrid bonds. Okay. So just to recap here, okay, in these 50-minute sections, right, just hope that we can at least have some concept or get some idea to understand the features and the features of the hybrid securities. And also they are giving a alpha returns here, quite an attractive returns here, but make sure you understand the complexity and also the special features on these bonds. Okay, and again, all the details can be found in the bond prospectus. So if you have time, just take my starter pack to at least go through the executive summary of the bond and also the PTC of the bond program. So slowly you can know what is the information that is important to you. Okay, so I guess this sums up to my sharing sections today, and I'm ready to take some questions here. Okay, let me see whether there's any questions from the crowd. Okay, I can see one question stating that what are the leading indicators that the bond issuers are having stress level, for example, Evergrande. Okay, there's no a standard answer for that, but I would say the most relevant information to those, right, could be the whether this company has a steady or consistent operating cash flow. So profit, it might be in a real cash term or non-real cash term. So the most important thing is that we have to make sure this company has a proven steady cash flow in order to make sure they have the ability to pay back the coupon payments and also the final principal payment. Okay. And also sometimes we have to consider their debt level as well across the tenor. So maybe some bonds that was going to be matured in 2023, 2024 time, we have to be sure on their maturity profile there. Okay. Okay, I also see questions regarding Sabah Dynamics stating that Sabah Dynamics still at risk to comply the covenants. So will the latest financial report, with the financial report, what are the risks? Okay, so for Sabah Dynamics, right, they also have the these covenants to submit the audited financial statement to the bank negara. Bursa Malaysia. Okay, so the deadline for them is actually up to the end of October. So after this period, if they fail to do so, right, then it will trigger the violation already. Then from there, right, since it's not a actual default case, so we will have to see what is their action, whether they will seek consent from the bondholders. Okay. Okay, which is better, comparing perpetual bond and private placement? There's no standard answer for that as well, because private placement is just the bonds with small issue size. Okay, so the concerns for private placement bonds is just since the issue size is relatively small, so there's no active trading activity there. So the risk is that you might not be able to sell the bond before the maturity, because you might not get a potential buyer from the other side. But for perpetual bond, normally you don't have this kind of restrictions unless the issue size of that perpetual bond is small. Then they will carry the same liquidity risk. Okay, I can see one question regarding the Tropicana recent bond issue. They say that it doesn't make sense for them to pay the additional 2% interest, right? Yes, exactly. So this is the cost to protect the issuer as well. Because for bonds, right, 5 years investment period, not too long, but is still considered a quite a tenor for them already. So in order to make sure issuer they are to redeem back the bond on the next call date, right? They will list the cost here to make sure they are okay to do so. So this is also the protection to the issuer. It cannot be all the clauses that brings benefit to the issuer. They have to be at least something that brings protection to the bondholders. If not, right, because if they choose not to call back the bond, then they have to wait for a year and another year. So it doesn't really make sense to the bondholders. But they are still giving them the last resort there. If let's say 5 years later, Tropicana, they really have some cash flow problem, right? Then they can actually choose to defer the bond to another 5 years. So this brings, I would say this brings benefits to both sides. So if let's say the company don't have any issue, then they will just redeem back the new bond and also issuing another new bonds. Okay. Okay, one question is regarding the CET1 ratio. What will make the CET1 to come down to a lower level? Okay, normally I would say is in normal circumstances is where banks are making losses. So if the banks are making losses, right? Remember, I say the lower tier is what that consists of the common shares and also the retained earning and all those reserves. Okay, so if let's say banks are making losses, so their retained earning portions will be getting lesser and lesser. Okay, if banks are seeing any depositor comes to the bank, they want to withdraw the money, right? Then their reserve portions will be reducing as well. So if let's say the CET1 ratio they cannot maintain, right, then they will need to take the absorptions from the slightly higher ranking, like the AT1 and also this tier 2 capital there. Let me see. Okay, where can you access the bond prospectus of an issuer? Go to our FSM website where you can click on the bond fact sheet itself, right? So let's say you want to know more about Tropicana issuers, you just search the bond name, then you click into it, right? You scroll in the at the bottom, you will see there's a related documents there where you can download it, and then you can take a look at the documents there. Okay, and another way is that you can go to our Securities Commission website, and it's called BIX Malaysia, where they contain every bond documents as well. So there are two ways for you to source it. Okay, I think due to the time constraint, right, I guess I will take last two questions. Let me take a look here. Okay, seeing one asking the interest rate anticipation with US Fed forecast to have rate hike by end 2022 to 2023 time. What are the potential impact to Malaysia? Okay, normally, right? Normally since US is the big company that most of the countries will follow, right? So if let's say for Malaysia context, if let's say we are seeing a good sign of recovery, right, and we're also seeing some unexpected inflation pressure, right, then most likely Bank Negara Malaysia, they will take actions to control the inflationary pressure there. So it's not closely related, but in the end, it still depends on our country's economy recovery performance there. So if let's say we are seeing a good sign of recovery that exceeds our expectation, right, then there might be cases that the Bank Negara Malaysia, they will hike the rate to sort of control or calm the inflation rate. Okay. One last question. Let me see. Okay, one question regarding Evergrande. In what circumstances can the issuer enforce haircut on the bondholders? Can bondholders insist company to wind up to get back full capital? Okay, from our experience, right? I mean, if in the case of default, right, it depends on case by case basis. But from our experience, right, normally for the senior unsecured bondholders, right, from our experience, they don't really not many of them will get full repayment in that case. So we can definitely, as the rights of bondholders, right, we can actually raise this case to the court to ask for the liquidity, to ask for the company to liquidate the company. Okay, and then whatever the asset they have, right, they will have to depends on the market value of it, meaning whether they can successfully sell the assets based on the market value. Because in that situation, right, the advantage is definitely on the buyer side, so they might press the price to buy the assets. So in the end, right, there might be some haircut there. Okay, I think we are slightly exceed our time here. So I guess if you have more questions, just feel free to drop a text to our client investment team, or you can straight away call to our bond dealing line to ask more if you wish to. So I guess I will have to end the sections here.
Thank you, Randee, for the insightful presentation. If you have further questions, feel free to send us an email at clienthelp.my@fundsupermart.com. A replay for today's session will be available right after this. Head over to our YouTube page at FSMOne Malaysia to catch this replay. We will be having another webinar session with Manulife Asset Management on this coming Wednesday, 20th October, where we'll be talking about retirement planning. If you haven't registered for this event, please head on to our website now at www.fsmone.com.my to register. Once again, thank you very much, Randee, for joining us today, and thank you everyone for attending today's session. Have a good weekend.
Thank you.
Thank you.